Hi, I'm Al from the Money Study, bringing you another episode in our series of You and Your Superannuation. This is number 12, talking about insurance inside your superannuation. Before we kick off with the details, there's the disclaimer. It's all about facts, it's all about figures, it's all about information, and it is not advice. Okay, most super funds do provide insurance inside your super. And of course, we can buy insurance, and we're talking about death cover and total permanent disability cover and income protection cover, which we'll go through here. Outside of super, I mean, you can go to companies like AMP and the banks and Colonial and all these other companies that have been providing insurances for a long time, and we can just get them as a standalone policy and pay for them on a monthly basis or perhaps an annual basis, just with money from our bank account. We send them off a cheque. Or we can indeed have our insurance basically inside of our superannuation, meaning that we don't have to find the premiums for this. Now, we're still paying for it, don't get me wrong there, we're still paying for the insurance, but basically what it boils down to is we don't have to find money out of our back pocket every fortnight. It literally means that the premiums for the insurance are effectively coming out of the earnings and our contributions into our super fund. So this has got advantages, it's also got some disadvantages, but we'll go through this bit by bit. But effectively the advantage, of course, is we don't have to find this money from our cash flow. And so if you're a bit strapped for day-to-day living, then increasing our insurance if we need to isn't going to impinge upon further problems to our lifestyle. Yes, it's going to slow down the growth of our super, and that certainly is a consideration that we need to take into account. But it is a case that it might be easier to increase your insurances inside super, literally because of this cash flow issue. And of course, you can't claim a tax deduction for death cover and TPD cover. You can for income protection. If you've got policies outside of super, and you've got an income protection policy, yes, it is indeed a tax deduction. Whether you need the tax deduction or not, that's up to you. But for death and TPD, no, there are no tax deductions for having insurances. Whereas if we've got this inside our super, then effectively it's been paid for by concessional contributions from our employer. And if you were indeed concerned that your super isn't growing as sufficiently because of these insurance premiums, and you can afford to pay for the premiums, literally what you could be doing is you could indeed salary sacrifice or make a concessional contribution to your super, and it could be just enough just to cover the insurance premiums. And by doing that, you get a tax deductions for making a concessional contribution. Hence, effectively getting a tax deduction for death cover, TPD, and your income protection, literally by paying for the premiums in pre-tax dollars. So if you're not too sure about how this concessional and salary sacrifice works, have a look at one of the earlier sessions that I've done on concessional contributions. So yes, generally with most super funds, they will offer you death cover, meaning you die and your beneficiaries get the money. Total permanent disability cover, so you've been hit by a bus and effectively you'll never be able to work again, and any issue that you can't do your job, then effectively you get paid out this benefit. An income protection, which I'll go through in a fair bit of detail as well, it provides you with, as it says, an income should you be in a situation where you've got an issue where you can't go to work. So generally speaking, I love that word generally, generally speaking, insurance inside super can be cheaper than getting insurance outside of super, because you see, most of these super funds who provide insurance, they are not the insuring company. They actually go out to tender to a company that's providing the insurance, and because the super fund is telling the insurance company, hey, we've got 100,000 members here, we'd like to get some insurance covers for our members, all of a sudden the insurance company goes, oh wow, we've got all these new clients, all these new members, then they generally speaking provide discount to the super fund. And with super funds like the big industry super funds, which are effectively non-profit, then effectively you benefit from those lower premiums. So they provide the insurance cheaper to the super fund. The super fund should and therefore pass on those lower premiums to you. So quite often it will be cheaper. Now, of course, because they're going out to tender, the tenders do expire. And so you will find every, I don't know, 3-5 years or so, whenever their contract runs out, that your insurance premiums may go through a readjustment as they either going under a new contract or may even be going to a totally different insurance company for that insurance. And of course, all of the companies and the super funds and the different insurance companies and so forth all provide different services. So it's got to be make sure you understand what you're getting for your money. Quite a few of them do indeed even provide free rehabilitation service in the event of a claim, so that they're really trying to get you back to work rather than paying an income protection. It's cheaper to pay the rehabilitation to get you back to work than have to pay the income protection. So most of them you can jump online, and there'll be an insurance tab on your super account, and on that you can normally get a quote, so you can sort of put in there, what about if I increase my insurance up by another 200,000, or I change my income protection some way or another. So normally it's fairly easy to update in that situation. So just jump onto your super fund, have a look. And also a lot of the super funds provide what they call an insurance calculator, or a tool to basically assist you in working out how much insurance do you actually need. Because this is obviously, we're all different, and different family situations, different amounts of debt and kids and living expenses, and so it goes on, that we don't all need the same amount of cover. And yet, generally speaking, when you join one of these big industry style funds, then normally they will indeed provide you with a minimum cover, providing that your employer basically is paying their contributions into the super fund. So they can see that you've joined and that immediately your employer is going to start paying contributions in. Then they would normally give you some form of minimum cover without any underwriting, meaning you could indeed have a medical condition, but they'll bring you on literally because they're getting hundreds of different people or so into the scheme. So there are a few things to consider there. It's just a case that obviously just because you're given a level of cover doesn't necessarily mean that that's the cover that you have to, or that's A, is it appropriate for you, and B, do you actually need to keep that cover? You could certainly either decrease it or increase it depending on your needs. Now, the death and TPD, as I said, the death is a payment directly to you. To your beneficiaries, you can't get it, you're dead. But if you suffer a total permanent disability, yes, the payment comes to you to assist you, maybe for medical costs, maybe putting wheelchair access into your home, or whatever you want to actually use the money for. The beneficiaries would receive a lump sum payment. Now, if you do opt out, saying, look, yeah, I don't need this insurance, I'm only young, I'm only 22, I'm living at home, I don't have a mortgage, I don't have kids, why have I got this insurance? Do I actually need it? And probably the short answer is no, I don't need death cover under that scenario. But be aware that you do have what's called guaranteed reinsurability under most cases, which means that if something did occur and you were ill and you had the insurance cover, then they couldn't knock you back from having it next year. They'd already taken you on under the circumstances. So if you do opt out and saying, yes, I don't want the insurance any longer, then you later on decide to have 3 children or take on a big mortgage and you realise, perhaps I do need some insurance cover, and you then reapply, then yes, they will expect you to do some sort of a medical questionnaire. Why do you want this cover? What's wrong with you? Have something going on here that all of a sudden you want to reinstate the insurance? So you fill out a medical questionnaire. Now, providing your health is okay, you could indeed just go through the medical questionnaire online, and it could indeed, by the end you get to the question, you go no to all these questions. Literally could be approved at the end of the last question. If, however, you've said yes, I've got asthma, it probably then would open up a asthma questionnaire to see what the severity of your asthma condition. And again, if it's something obviously very, very mild, you still might get approved at the end of it. Or it could indeed be a case that, yes, there's further questions that the underwriter, the insurance company, needs to know before the approval of the insurance there. So there are normally two different types of basically getting your death and TPD cover. You can either get what's what they call an age-based cover. So how old you are determines how much cover you basically automatically get. Or alternatively, you can just say, look, no, I need $500,000 worth of cover, irrespective of how old I am. Here I am at 62, still got 7 kids at home, or or a huge mortgage or whatever. So still needs the cover. With this age cover, it's sort of, most of them, it looks a bit like this. I mean, their amounts are different from company to company, but the dark blue covers, say for death cover, and the more lighter blue colour, there's probably the amount for TPD. A lot of these super funds will provide you with half the cover of your death cover for TPD. But you can see there that this is from a super fund, where what they're saying is that if you join in your 19s and 20s and so forth there, you get about $150,000 of minimum cover if you want it, and about $75,000 or so in the TPD. Generally speaking, you don't need much cover, so they'll offer you a smaller amount there. And then it sort of ramps up pretty quickly when you get up towards your 30s, literally, because yes, you're starting to think about having families and buying a house and say mortgage, so your requirements are up there. But then when you get to sort of 40s, yep, in theory, your debts are going down, your kids are starting to move out. Good luck with that. They might be starting to cost you less money. Yeah, good luck with that too. But yeah, in theory, we don't need as much insurance as we get older, and so it drops off. And also, the insurance company doesn't really want you to have this higher level of cover the older you get, because there's more likely you're going to make a claim. So this is the way it works. So as you get older, the metal level drops down, this automated minimum cover there. And you get up to my age and you've got about $7,000 worth of death cover, just enough to dig you hole to put you into the ground, and that's about it. So it becomes a point at some point there, you've got to say, look, really, what I'm paying for this and what I'm getting back for it, is it all really worthwhile? So check your state and see what level of cover you've got, and see your premiums to see what you're actually paying. I get amazed that people, said, oh, I didn't even know I had insurance, or didn't know that that's what it was costing me. And, I thought I had 300, but they haven't looked at it in 10 years. And of course, it's dropped down to quite a much lower level. But I say, if you don't want this sort of fixed age-based cover, you can indeed get fixed cover and say, look, yes, I need $2 million worth of cover. In some of these super funds offer you, $20 million worth of cover. I mean, that would be rather expensive, I'm guessing. But yes, you can increase your cover to whatever level you like. But if you are indeed going to increase your cover, the insurance company will always want some underwriting done, some questions done, find out why do you want the extra cover. Now, having said that, if you've triggered what's called a life event, meaning that you have just got married, you've just bought a house, you've just had a child, you've had a promotion. These are all things that are, significant events in your life, and indeed would probably change your spending habits and your situation, in which case, therefore, most of the super funds will offer you an increase in your insurance without any questions asked, up to a certain amount based on these lifestyle events. So you can just ring them up and say, look, yeah, I've just had a baby, need more death cover, or more, whatever, and generally speaking, just talk to them and they will let you know what that would pay you under those circumstances. Income protection, look, to me, is probably, well, certainly to me, more important in many cases, in the regard that if you haven't got enough money coming in, Well, you can't even pay your house insurance, or you can't pay the rent, you can't pay the mortgage, you can't do anything if you don't have any income coming in. Now, if you've got oodles of sick leave and another leave up your sleeve, well, then okay, you can take that into consideration. But if you really, very lean on the ground with leave, then income protection can certainly help out here. What it does, it generally pays you 75% of your salary. 75% of your salary. Some of them include the employer contributions, and so that to super. So you might be getting 75% of your salary, but then you also get 11% or 15.4 if you're a public servant going into your super to cover the employer contributions as well. Now, it's generally anything that your doctor says you should not be at work with income protection. So it's effectively, you've got a broken leg and, something has happened. It's not, TPD is where you're totally permanently disabled. You never come back to work. Income protection is an ailment or an injury that effectively you will indeed come back to work with treatment. Now, depending on your super fund and your other, you may have income protection outside of super. You might have a benefit period, meaning it pays you for being sick for 2 years or 5 years. Some income protection policies will pay you up to, you might be 30, you can get income protection up to 60 or age 65. Those normally aren't available in super. Normally you'll find it's just a 2-year or a 5-year benefit inside your super there. But it is a benefit per ailment. So if you, let's say you were off for a year with some sort of a cancer scare, you got the payment paid to you, and a year later you've been treated and you've gone back to work, but then unfortunately down the track you've been hit with the same ailment, then you've got 1 more year on income protection. You wouldn't have to go through the waiting period, literally because you've already been diagnosed, but you would only have a year to go. Whereas if you had a cancer and you used up 2 years or so, and then straight away had a broken leg, totally different ailment, you'd actually get the time off for the broken leg on top of the time off you had for your cancer scare or whatever the case may be there. So if you're going to get sick, just make sure it's something different every time there. There is also this not only a benefit period, but a waiting period, meaning how long do you actually have to be sick for before you can make a claim? Most of them is 60 days inside super. The 90 days can also be quite common. So either 60 or 90 days, meaning you've got to be sick for either 2 months, 3 months before you can indeed make a claim. So now obviously you don't have to use up all your sick leave first. So you might have 6 months worth of sick leave and you go, well, hang about, I've got this income protection that's kicking in. But income protection only pays you for 75% of your salary, where your own sick leave would pay you for the whole amount. But it could come down to you say, look, I wouldn't mind just keeping a little bit of that sick leave up my sleeve for in the future. I mean, someone of my age, if an older person would say, look, no, let's just use up all the sick leave first because I'm getting close to retirement. But a younger person might say, look, no, I'll keep a little bit of that sick leave ahead just for odd days here and there until I can rebuild up my leave entitlements there. Now, of course, if you drop the waiting period, so if you go down to say a 30-day waiting period because you just don't have any sick leave, you don't have any leave, you really are, you'd be in a diabolical situation if you didn't have income coming in for a month, you could drop it down. But of course you are now a higher risk to the insurance company, and therefore, as a higher risk, your premium for this insurance would indeed go up. Whereas if you push it out saying, look, I've got 6 months worth of leave here, I'll push it out to 180 days or so before I have to make a claim, or use up all my leave or a big chunk of my leave before I make a claim. Because you are now a lower risk to the insurance company of ever making a claim, this will decrease your premiums. So you've got a bit of control here over either increasing your benefit period, so it pays you for longer, and or decreasing or increasing your waiting period, depending on your leave entitlements and what you can indeed do. So it really is a case before you do any changes. So especially if you're opting out of all the cover, well, you've got to do that in writing. You've got to put in writing that you're opting out. But just really make sure that you understand that you can't just get straight back in again with automated cover if you would actually have to reapply. You'd have to reapply, and then you could get knocked back literally because you did have, asthma when you were 16 or something really dumb, and something not too drastic. So anything to do with insurance, it always just comes down to sitting down with your partner if you've got one, or just nutting out. What would happen to me? What would happen to my family? What would I be leaving, to my beneficiaries and so forth, if I was to die, or what would happen for me if I suffered a total permanent disability or was off work for an extended period of time? How would you cover it? Could you afford to cover it yourself? Could you self-insure, as they say, or would it really put the whole family in diabolicals? I must admit, I get to see. I reckon 75% of the people I see are what I would call underinsured, and at least 20% are vastly underinsured. People say, I can't afford it. Well, you can't afford not to be insured under certain circumstances there, so utilise your super if that's a better method for you. So in the red writing at the bottom, insurance policies contain definitions, conditions and exclusions. They're all different. And they can affect what you're going to get paid. So make sure you read that product disclosure statement that could be pages and pages long, and all this fine print buried in it all amongst it all. But obviously, if you do have health issues and it's critical, make sure you've got the right policy to cover you if you can get it. A lot of them, especially around the TPD, have different definitions as to what makes you totally permanently disabled. Is it a case that you can't do your job, or you can't do any job? Because that's a significant difference, especially for someone like a plumber or a bricklayer or something. It's can really make a big impact. So read the instructions, read the fine print. Just make sure what you've got. And of course, if you're filling out any forms, make sure you're 100% accurate. If they find out you've been lying on your application form, they can basically say, look, no, we're just not paying you, irrespective of what the lie was, effectively. So be careful. Make sure you know what you've got, what you're paying. If you've got any issues around it, we can certainly help you with some of these online calculators to work out what you need. Many of those online calculators for insurance are owned by insurance companies, so they're a bit Rolls-Royce in the regard that they really are premium insurance because they want to sell you the insurance. There's quite a good calculator on the MoneySmart website. So MoneySmart's run by ASIC, the government organisation. And I find that one to be pretty good because they're not trying to sell you anything. They're just trying to go through your scenario. You punch in there, your age, your income, your debts, and so forth, your kids, and it'll come back and tell you what you really should and shouldn't have. If you ever then want to discuss that any further, we certainly can make an appointment to discuss insurances and how they tie together. Remembering that if you've got death cover, say, in an A&P policy outside of super, and you've got death cover inside your Australian super or whatever you might have, and you die, yes, both of those death covers would indeed pay. But if you've got income protection in a policy outside, or even in another super fund, and then you've got income protection in another super fund, and you get sick, are both insurance companies going to pay out? No, because you'd end up with more income by being sick, and there'd be no incentive for you to go back to work. So only one insurance company is going to pay effectively. So if you've got two income protection policies, then effectively you're paying premiums for something you're never going to get paid out on. So please check what you've got. If you've got more than one fund, do you have multiple insurances? And what are they? And what do you actually need? A lot to think about. We'll talk again on another session.